Hi, good day, sir, and my fellow classmates. We are from Treasury Management Group A. Today, we are going to present about the money market instruments of Singapore, Arab, China, India, and US. So, let's start the presentation.
Hi, good day, sir. I am Leelana, your daughter of Sridharan. My matric number is 267564. I had chosen the Arab countries for the money market instrument. Now I am going to talk about the banker acceptance and bill of exchange. A banker's acceptance is a negotiable piece of paper that functions like a post-dated check. Although the bank rather than an account holder guarantees the payment, bankers' acceptance are used by companies as a relatively safe form of payment for large transactions. The banker acceptance also is a short-term debt instrument similar to a US Treasury bill. For the company that issues it, a banker's acceptance is a way to pay for a purchase without borrowing to do so. For the company that receives it, the bill is a guaranteed form of payment. A banker's acceptance requires the bank to pay the holder a set amount of money on a set date. They are most commonly issued 90 days before the date of maturity but can mature at any later date from 1 to 180 days. They are typically issued in multiples of 100,000. Banker acceptance are issued at a discount to their face value. Thus, like a bond, they earn a return. They also can be traded like bonds in the secondary money market. There is no penalty for cashing them in early, except for the lost interest that would have been earned had they been held until their maturity days. Use of bankers' acceptance is most common in international trade transaction. A buyer with an importing business can issue a banker's acceptance with the date after a shipment is due to be delivered, and the seller with an exporting businesses will have the payment instrument in hand before finalizing the shipment. The person who is paid with the banker's acceptance may hold onto it until its maturity date in order to receive its full value, or can sell it immediately at a discount to face value. I'm going to talk about the bill of exchange. A bill of exchange is a written order used primarily in international trade that binds one party to pay a fixed sum of money to another party on demand or at a predetermined date. Bill of exchange are similar to checks and promissory notes. They can be drawn by individuals or banks and are generally transferable by endorsement. A bill of exchange transaction can involve up to 3 parties, which is drawee, payee, and drawer. Drawee is the party that pays the sum specified by the bill of exchange. The payee is the one who receives that sum. The drawer is the party that obliges the drawee to pay the payee. The drawer and the payee are the same entity unless the drawer transfers the bill of exchange to a third party payee. Bill of exchange generally do not pay interest, making them in essence post-dated checks. They may accrue interest if not paid by a certain date. However, in which case the rate must be specified on the instrument. They can conversely be transferred at a discount before the date specified for payment. A bill of exchange must clearly detail the amount of money, the date, and if a bill of exchange is issued by a bank, it can be referred to as a bank draft. The issuing bank guarantees payment on the transaction. If bill of exchange are issued by individuals, They can be referred to as trade drafts. The funds are to be paid immediately or on demand. The bill of exchange is known as a side draft. International trade, a side draft also allows an exporter to hold title to the exported goods till the importer takes delivery and immediately pays for them. However, if the funds are to be paid at a set date in the future, it is known as a time draft. Draft gives the importer a short amount of time to pay the exporter for the goods after receiving them. That's all from me. Thank you, sir.
My name is Zhao Zixu. Metric number is 252782. I will talk about treasury bills and bills of exchange. Treasury bills is a type of government bonds issued by the national financial authorities to make up for the imbalance in the revenue and expenditure of the national treasury. Treasury bills were invented by British economist and writer Walter Bezos in 1877 and were first issued in the UK. It's a credit tool with the least risk in the financial market. The shortest term of Chinese treasury bills is 1 year. It can generally be divided into 3 months, 6 months, 9 months, and 1 year. Treasury bills feature can provide hedging for other certificates when their return fluctuates. Treasury bills have a vast secondary market, easy to change hands, can be cashed at any time, and have a high reputation. Treasury bills are the government's direct debit, which is the lowest risk investment for investors. The interest rate of treasury bills is generally lower than that of bank deposits or other bonds. Because the interest of treasury bills is expensed from income tax. For the Chinese treasury bills of history, in 1950, the state issued the earliest national bonds. It's called the People's Victory Convertible Bonds. In 1954, the Central Ministry of Finance issued the National Economic Construction Bonds. In 1958, the country's economic order was disrupted due to the Great Leap Forward and exaggerated wind. In 1980, the issuance of treasury bills was resumed. Many people didn't know the same about the stocks that were issued at the time. In 1981, the treasury bills issued were our physical bonds, with face value of 1, 5, 10, 100, 1,000, 10,000, and 1 million yuan. In 1983, issued 50 yuan face value treasury bills. In 1990, people gradually became aware of treasury bills, which were issued by means of underwriting. In 1992, the state began to issue a small number of certificate-style treasury bills. In 1997, they have all deposit certificate style and online applies in insurance of securities markets. This picture is 10 yuan of Chinese treasury bills in 1982. For bill of exchange, one of the most common types of bills, Article 19 of Chinese Negotiable Instruments Law, the bill of exchange is the most widely used credit tool in international settlements. It's a kind of in-trust securities, and the basic legal relationship has at least three persons: the drawer, the drawee, and the payee. From the point of view of the parties, when a bill of exchange is issued, there are basically three parties: the drawer, drawee, and payee. A bill of exchange is an in-trust security and a payment order. Forward bills must be accepted. Diversification of payment days. This is a bill of exchange from Chinese bank. That's all for my part. Thank you.
Good day, sir. My name is Lingeshwari. My metric number is 267734. Today I'm going to present about the money market instruments such as treasury bill, commercial paper, certificate of deposit, bank acceptance, repurchase agreements, and Chagamas bond of the Singapore. First, we look into the treasury bill. Treasury bill is a short-term securities which have maturities of 3 months to 12 months. 12 months means equals to 1 year. The purpose of this instrument is raising funds to the further financial business and helps to expand the business. Okay. The parties involved for this instrument is Monetary of Singapore, MAS, are involved in this created. On behalf of the Singapore treasury bills, the government, the Monetary Authority of Singapore, issues treasury bills of 3 months and 1 year maturities. Both Singaporeans or foreign residents can invest in treasury bills. There are also no restriction to non-restriction. So, the Singapore's treasury bills are denominated in nominal values of Singapore currency SGD 1000 and traded at a rate of discount basis. So, we can sell the treasury bills before maturity by the price will be subjected to the market force. Next, we move to the second instrument, which is certificate of deposit. These instruments are also known as a time deposit. This type of bank deposit that provides a higher interest rate compared to the saving accounts. Okay, for example, when you deposit your money, you will be issued a certificate that holds the terms of the accounts. So, whatever amount you deposit cannot be withdrawn until after the terms specified in the certificate. So, from the part of Singapore's certificate of deposit are called Singapore dollar negotiable certificate of deposit. It is the financial instrument that usually bear from issue by a bank acknowledging the deposit of a specific sum of money for the fixed period of time. And it is issued in the Singapore dollar, which is SGD. So, the benefits of this instrument is due to the competition among banks, this is the better rates are offered to the investors among compared to the other instruments. So, and also at disadvantage for this instrument is the monies get stuck until the maturity, because when we deposit of a specific sum of money for a fixed period, so the money gets stuck until the maturity will end. Okay, next we move to the commercial paper instrument. This is the one of the short-term unsecured negotiable instrument consisting of promissory notes. So, the corporate, primary dealers and the all financial institutions of Singapore are eligible to issue this commercial paper instrument. This corporation primarily issue commercial paper to meet their short-term liabilities like such as account payable and inventories. There are many commercial banks in Singapore which issue commercial papers for the maturity between 1 to 3 months. The commercial paper is usually sold at the discount basis to its face value and is cheaper to other forms of borrowing. Commercial paper is not used as a short-term investment option due to the lack of liquidity in the SG currency market. Next, we move to the one of the important money market instrument, which is repurchase agreement. Repurchase agreement is also called as repo and or reverse repo. Repurchase transactions are normally short-term loans which two parties agree to sell and repurchase the same security. And this instrument used for overnight borrowing. Under the agreement, the seller sells specified securities with an agreement to repurchase the same at a mutually decided the future date and the price. Such a transaction is called a repo. When viewed from the perspective of the seller of the securities, and reverse repo when viewed from the perspective of the buyer of the securities. Repurchase agreements in Singapore. The Singapore has an active repurchase market. So, there are two types of repurchase agreement in Singapore. One is the general collateral repurchase and another is specific repurchase. The Monetary Authority of Singapore MAS adopts the Public Security Associations or International Securities Market Associations Global Master Repurchase Agreement in relation to repurchase transactions. And there is also Islamic money market instruments in Singapore. One of the Islamic instruments, which is the Chagamas bond. Chagamas issues the debt securities to finance the purchase of housing mortgage and other consumer receivable for the both conventional loans and Islamic financing. Leading Malaysian issuer Chagamas printed its debt Singapore's Suku to build a vibrant Islamic finance. Suku paper in Singapore is among the lowest yields in the world. That's all from me. Thank you.
Hello everyone, this is Manisha Thamodaran and my metric number is 268043. I would like to present about treasury bills and commercial paper. Since we asked to do it in specifically, I choose India. So I will present treasury bills and commercial papers of India. Treasury bills or T-bills, which are money market instrument, are short-term debt instrument issued by the government of India and are presently issued in the three tenors, namely 91-day, 182-day and 364-day. India will allow individuals to bid in the government's treasury bills auction to encourage wider participation, the Reserve Bank of India. Then, treasury bills are zero coupon securities and pay no interest. How many treasury bills are there in India? For now, the government of India issued four types of treasury bills, namely 14-day, 91-day, 182-day and 364-day. Treasury bills are available for minimum amount of 25k rupees and in multiples of rupees. Treasury bills are zero coupon securities and pay no interest. Instead, they are issued at a discount and redeemed at the face value at maturity. This is how treasury bills works in India. Treasury bills are issued only by the central government of India. The state government do not issue any treasury bills. Interest on the treasury bills is determined by the market forces. Treasury bills are available for minimum amount of rupees. Who can purchase treasury bills? Okay, individual firms, trust institution and banks can purchase treasury bills. The commercial and cooperative banks use treasury bills for fulfilling their SLR requirements. Okay, next I'm going to talk about the commercial papers of India. What is commercial paper? Commercial paper is an unsecured money market instrument issued in the form of promissory note. It was introduced in India in 1990. Why is it was introduced? It was introduced in India in 1990 with a view to enabling tightly rated corporate borrowers to diversify their sources of short-term borrowings and to provide an additional instrument to the investors. Then, who can issue commercial papers? Corporate primary dealers, which is called PD, and the All India Financial Institution are eligible to issue eligible to issue commercial papers. What is the minimum and maximum period of maturity prescribed for CP? CP can be issued for maturities between a minimum of 7 days and a maximum of up to 1 year from the date of issue. However, the maturity date of commercial paper should not go beyond the date up to which the credit rating of the issuer is valid. Okay, then who can act as issuing and paying agent? Only a scheduled bank can act as an IPA for issuance of commercial paper. IPA means issuing and paying agent. Okay, and then who can invest in commercial paper? Individuals, banking companies, and other corporate bodies registered or incorporated in India, and unincorporated bodies such as unincorporated bodies, non-resident Indians, which is called NRA in short form, and foreign institutional investors, etc., can invest in commercial papers. However, investment by foreign institutional investors would be within the limit set for them by Securities and Exchange Body of India from time to time. Whether CP are traded in the in the secondary market or not. Yes, CP, which is called commercial paper, are actively traded in the OTC market, such as transaction. However, are to be reported on the reporting platform within 15 minutes of the trade of dissemination of trade information to market participation, thereby ensuring market transparency. Okay, we have seen both treasury bills and commercial papers of India. That's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Imran Nabi Jafar with 26540 from the number. So today I would like to present on the money market of United States of America. So in this presentation, it will be consist of repurchase agreement, commercial paper, and short-term tax exemptions. So let's move on to the first instrument, which is repo, which is repurchase agreement of USA. So firstly, a repo. A repo is mean as the instrument of short terms that traders will be sell to the investors in overnight daily basis, and then the traders will buy back with higher price from the investors on the next day. So in repo, there are a few benefits, which is high liquidity due to the its overnight basis, so it is higher liquidity, and then it is safer due to functions of collateral, because the repo it is functions as the collateral, so it is more safer. And then can be used for gaining capital in short time. The repo could be used likely to be used by corporations due to its capital that could be gained in short time, which is overnight daily basis. And then there are two types of repo market, which is bilateral repo and tripartite repo. In bilateral repo, they're having a parties which consists of two parties involved, which is traders and also investors. In this bilateral repo, there have been directly interactions between the parties. So in the tripartite repo, it is a party that consists of three parties, which is bank, investors, and also brokers. So in this tripartite repo, it is to say more cost effective compared to the bilateral repo due to the presence of bank. So this is the table of the repo USA on the overnight basis based on the 2020 and 2021. Okay, in 2019, there have been a crisis on repo itself, which is on USA, that the repo to be set a higher 10% on compared to the federal. This giving a crisis to the USA itself, because of the overnight repo are more higher compared to federal, which is more by 10%. And then second instrument is commercial paper. So commercial paper is an short-term instrument where it is used for more likely to use by corporations for project like receivables. They use it for receivables, are more likely to use for their project. And then the commercial paper introduced on 100 years ago, where New York Commission began to sell the short-term obligation to dealers. And the first trader is Marcus Goldman. This is Marcus Goldman, where he is the first dealer in money market to purchase the commercial paper. And then it is to be said that the Marcus Goldman is the biggest commercial paper traders due to its first dealer. And then based on commercial paper, there are few benefits, which is firstly because of low risk investment. This is because the low risk investment due to commercial paper are likely to be issued by corporations, bigger corporations, and bigger banks. And then it quick and cost effective to raise working capital due to its short-term obligations. And then this is the rates of commercial paper between January of 2021. Okay, lastly is short-term tax exempt. Short-term tax exempt is an instrument of they be used for investors to free from any tax need to be paid. So the tax short-term tax exempt is benefit with no income tax because of they do not need to pay any income tax because of the instrument itself. But the instruments are issued by corporations, government or quasi-government, and then the instrument short-term tax exempt is to be said more risky compared to T-bills and also non-negotiable. And for example, this is the examples of short-term exempt, which is Vanguard short-term tax exempt fund. So based on the table, to be said that by 8 January, the price of the Vanguard short tax exempt is $15.95. So that's all for the in terms of USA money market. So thank you.